FX leadership, none to be found. Exchange rates are about relatives. Relative growth rates provide information about which currency can attract the most capital. Relative risks are an important part of the FX calculus, and interest rate differentials help market participants assess whether they are being compensated for the risks they're taking. Growth, risks, and rates were all in the U.S.'s favor in recent years. But no more. The U.S. economy is decelerating. The trade war with China has brought rising risks of doing business with the U.S. And the Federal Reserve has stopped raising short-term rates, has gone on hold for the whole year, and may even consider a rate cut depending on how the decelerating U.S. economy performs. This reversal of factors supporting the U.S. dollar does not mean the U.S. dollar will depreciate. The relative nature of FX markets means that one needs to consider the alternatives, and they all have their challenges. The euro does not look so great. The Eurozone economy has slowed down. German 10-year bonds yield literally nothing. The risks associated with Brexit are substantial. And speaking of Brexit, the British pound has risen a few pennies versus the U.S. dollar in 2019 year to date. And that's happened as the possibility of a long delay or a soft Brexit has become a little more likely. But the issue's still not settled, and there are plenty of risks in the fate of the UK-EU divorce. And UK interest rates are very low and do not seem to provide much compensation for those risks. China's economy does seem to be picking up a little steam in the first half of 2019. And as trade negotiations with the U.S. have increased in intensity, the Chinese renminbi has gained ground on the U.S. dollar. One interesting twist in the trade negotiations, though, has been that the U.S. now requests that China manage their currency to provide greater stability and to avoid weakness. This is a total reversal of the previous U.S. position that China should allow its currency to float freely. Now, the Chinese are probably fine with limiting any potential currency weakness. But if we are correct that the Chinese economy is doing a little better in 2019, that means the pressure is on the other direction, and the currency might gain strength. Except the Chinese authorities now may decide to prevent any currency strength, and that would mean they would accumulate more U.S. treasuries. One of the more interesting alternatives to the U.S. dollar is what is known as the FX carry trade. In the carry trade, one buys a relatively higher interest rate currency and sells a low or zero rate currency, such as the euro or the Japanese yen. If the exchange rate remains stable, then one earns the interest rate differential. Of course, the exchange rate never remains stable for these higher rate, higher risk currencies. What has changed in the FX carry analysis over the years, though, is that economic fundamentals now matter much less than politics. Mexico and Brazil have new presidents. Their honeymoons are over as they come to grips with some tough choices. India and Argentina face upcoming elections of their own, India in April, May, and Argentina in October. For all these higher rate currencies, one needs to decide whether the higher interest rates that are on offer can compensate for the substantial political risk. And it's a tough call. The U.S. dollar is no longer providing leadership, but no other currency has taken its place. I'm Blue Putnam, Chief Economist, CME Group.